All right, we're live and it's real talk on real estate. And we're talking about 50-year mortgages. That's what we're talking about today. And so I'll take a little Q&A on this as we roll in. Now, one of the big questions is the 50-year mortgage going to affect investors? Who's it affecting the most? And is it good or is it bad? Is it a bad proposal? They just proposed as well the assumption of your interest rate over to your new mortgage. So it's assumable to your new home. So some interesting stuff that just happened over the last 24 hours. So I just wanted to come in and address this because I see all kinds of crazy stuff. And here's what people are doing, right? They're assuming what people are going to do with the excess capital that they would have if the mortgage payments are extended out over 50 years. And so people are sitting back going, hey, America, you're intelligent, and you're going to take that extra $300 and you're going to put that in the stock market intelligently and sophisticatedly, and it's going to turn into $1 million over the course of 30 years. You and I both know that's all bullshit. That's not what's going to happen with people, okay? So let me explain what happens here, guys. The cost of money is your biggest variable in the real estate industry and in the real estate world. So if the cost of money is your biggest expense, how you leverage that capital is super, super, super important. And so I always tell people, you can go in, you can pencil a project, you can pencil the cost of the land, you can pencil the cost of the construction, and you can pencil the cost of stabilizing that asset. But if you don't take the cost of money into account, you can lose the entire project. In fact, you can even get land for free and pencil an entire project and still lose that entire project if you don't know how to underwrite and stabilize that asset. Now, let's talk about this 50-year mortgage, okay? Personally, I like it, and I'm going to tell you why. I'm biased because I'm an investor and I'm looking for inexpensive money and the best way to leverage assets, okay? So there's a difference. Now, you can go in and you can leverage a mortgage. Now, a house, you have to understand, is not a true asset. A true asset is income producing and it has a return on investment. A house really is a liability, okay? Now, do you need a house? If you have a family, you have kids, yes, you need a house. So although a house is a liability, you still have to treat it as though you're trying to leverage it as an asset. Now, let me explain what I mean by that, okay? Now, let's start with both. Let's first start with traditional home ownership, and then I'm going to move into investment in real estate, which is what I do. And my own house is an investment, guys. My house is an investment, and it is an asset to us because of the way we purchased it, the way we live in it, and the way at some point in time we'll either sell it or leverage it against the equity that we actually have in the house. And you have to think about it this way. So let's talk about it from a home ownership perspective. If you're going to buy a home and you're going to sit in that home for 50 years, the 50-year mortgage is horrible. You'll never pay your house off, right? Like you'll never have home ownership. It's horrible, right? So people are sitting back going, this is bad. Home ownership, they're extending it out. What do you think they did with automobiles just a few years ago, guys? After the 2008 recession, when nobody could afford automobiles, the cost of automobiles were super inexpensive. And then all of a sudden the pandemic hits, right? And all of a sudden, like I used to have a dealer's license with automobiles. And the reason I explain this through automobiles, because the exact same thing that happened in the automobile world is happening in the mortgage world today. Nobody owns their automobiles. So everybody was going out and they're leasing their automobiles, and they went from having a 3-year or 5-year payment to like a 10-year payment. Who keeps their car for 10 years? Okay. A few people, like we trade cars every 3 years, at least, sometimes quicker. And so if you keep your car for 10 to 15 years, some of these automobiles are financed for 20 years. And when they quote you the price of the automobile nowadays, they don't give you the price of the actual automobile. They give you the price of the monthly payments. They just don't tell you how long it's financed for. And so 9 times out of 10, you're upside down and have and the depreciation supersedes what you have as far as equity in the automobile. And so most people don't talk about that. They just drive, okay? But automobile ownership has extended out by a decade, which is crazy. Most cars don't even stay under warranty and aren't going to last you 2 decades, but yet they'll finance them for 20 years, okay? Same thing with homes, with capital improvements. Imagine your house has to get renovated every 15 years. Okay. Most people extend it, and the most home renovations take place after year 20. So you're at 2.5 times of renovation costs on a 50-year mortgage. So if you're looking from a home ownership perspective, yes, it's stupid. Okay. Now, we're not looking at it from a homeowner's perspective. We're looking at it, okay, what can we afford? Affordability, right? So they're looking at it as home ownership affordability. Now let's take a look at it on the contrary from an investment standpoint. I think it's brilliant. And so it's going to allow more people to buy homes. The average American only holds their home ownership, 85% of home ownership, it lasts 12 years. 85% of people stay in their home for 12 years, okay? So we sit back and we go, okay, well, 12 years, you're not sitting in it for 50. You're taking a depreciation of payments on your taxes. You're taking the tax benefits of it, and you have a home. You're living in, and you raise your family. Okay. Now, I'll be the first to explain that my first home, we built it and lived in it for 18 years. I paid about $250,000 for it, and we put about $75,000 into it immediately when we bought it. And so we're at like $325,000 to $350,000 into the house. Okay. We live in it for 18 years. Over the course of 18 years, we put in new doors, we put in new paint, new flooring, and more stuff, right? The house, and it's because we lived in it for 18 years. Landscaping improvements, and probably put in an extra 100 and some odd $1,000 into the house over the course of 18 years. Okay. So now we're in this house for $350,000, $450,000, $500,000, sell the house for $650,000. Okay. Now, when you take a look at your interest payments, tax write-offs and everything, we didn't make a lot of money after we pay commissions and to real estate brokers, so forth and so on. And so you barely get out of this thing, right? Living it for 18 years, you make $100,000. Woo, good job. Okay. Good job. We live in a nice friggin' home. We raise our kids with a nice neighborhood, a nice yard, and a nice home for 18 years. And then we go in to our house here. This is the only second one that I've done. Now, this house was built for somebody else. It wasn't built for us. So when we came in, I built this house for somebody else. And then when we came in and bought this home, I waited. It was a $2 million home back when we built this house. The person who bought it right out of in 2009, right out of the 2008 recession, was in it for 6 months, lost it, and it sat in bankruptcy, and not in bankruptcy, in foreclosure for like 8 years. And so after 8 long years of it's in foreclosure, it had mold damage, had a bunch of damage on the bottom. Bulgaris tankless water heaters had exploded. Nobody had turned off the water on the house, and so nobody wanted to buy it. So you take a $2 million plus home, and you take it down to sub $1 million. Okay, you come in, you buy it cash. Okay, we were able to do that, and nobody wanted to buy it because they didn't know how to handle the mold restoration. We came in, we did the mold restoration. We were able to spend about $300,000 getting the house even better than it was when it was new, and certifying it, and then coming in, and for just over $1 million, you live in a house that today is worth over $3 million. And now it's an investment, right? Now it's an investment. Now, will we have a mortgage on it for 50 years? No, because we pay cash for the house. Okay. So it's a little different for us, but it's a place we park and call home. Now, if I want to take an equity line of credit out on it, I can, and it's worth it. And if someone lives in a house like that and gets a 50-year mortgage, you have to think about it from a perspective like this. Okay. How can I reduce my overall out-of-pocket expenditures month over month? Okay. When you do that, who cares what you're paying for the cost of debt if it's low, right? You could buy down your interest rate to as low as 4% right now if you want to buy it down. With the money that you actually save on your monthly mortgage payments, instead of all the other bullshit that every other person on the internet is telling you, I'm going to go invest $300 in the stock market every single month, and for the next 30 years, I'm going to have $1 million. Woo! Bullshit. There is like less than 0.1% of all of you guys that will do that crazy bullshit, because no one's going to do that. You're not going to siphon $300 a month on a $500,000 home to go to the stock market. Theoretically speaking, woo, great, right? Here's the reality of it. What is your overall out-of-pocket expenditures every single month, month over month? What is the biggest U.S. issue that's happening right now? The biggest U.S. issue that's happening right now is inflation. Guys, most people were spending, 5 years ago. 5 years ago, the average U.S. American was buying a home that cost $189,000. That was the average median home cost. Today, average median home cost is just under $400,000. It was at $412,000. Now it's sitting at $390,000. That is the average median home cost. Interest only, guys, interest only. The average US American today from 5 years ago is spending $24,000 a year in interest payments, meaning it's trash can money. It's money you're taking and throwing in the trash. You're never going to see that money again. Yes, you can write that off on your taxes. So that is one great attribute of that interest payment. Now, here's what's even better, okay, is that instead of going out and paying that $24,000 in interest, reduce it and extend it, guys, because home ownership is jacked up today anyways. You're not going to have the same equity stance in your home that you once did unless you buy a piece of land and you build the house and retain the equity on the front end, not the back end. Everybody's trying to get this back end equity. You're going to die before you get back end equity. It's bullshit. And so why are you sitting out there trying to get back end equity? Create your equity on the front end. The front end, the only way, there's only one way to do it, ladies and gentlemen, one way to retain the equity on the front end. And it's to buy a piece of land and build the house yourself. It's called an owner build. And you can come in and you can do a one-time close with less than 5% of equity, not 5% down payment. Listen, 5% equity contribution into that build. It's a 5% equity contribution to that build. It's not a 5% down payment. It's a 5% equity contribution to that build, which means you could be into it $0 out of pocket with just a 5% equity contribution. Most people don't understand this concept because most people are taught about conforming lending. That's what the 50-year mortgage is. It's conforming lending. It's the type of lending that someone goes out because a liability can't afford itself, not an asset, a liability can't afford itself. And so the liability is the mortgage itself and the house because it is not income producing, which means that you have to go in and take your debt to income ratio and your credit score to say your income that you make doing something else, not the asset, because it's not an asset, not the house, that you go out and do. So if you're a police officer, if you're a nurse, if you're a doctor, if you're a dentist, if you're whatever you go out and do full time, if you're a service worker, whatever kind, you're in the military, whatever you do, if that income qualifies you to buy this asset, liability, not an asset, liability, then you qualify. Because it's not an asset, it's a liability because you are the only standing strength behind that mortgage, okay? And so understand that the only front end ability you have to walk into that house with equity is by buying a piece of land and building it and capturing that equity on the front end, okay? Same way we did with ours when we bought it out of foreclosure, okay? You buy it out of foreclosure and it's distressed and you strategically reposition a financially distressed asset. Now you have front end equity, okay? Those are the only two ways to create equity in your residence. It's not going to happen through a mortgage, guys. Don't sit back and go, oh my God, this 50-year mortgage is going to crush Americans. No, it's not. It's going to save Americans money. Your house is a liability anyways. And this new proposal that Trump is coming out with to assume your interest into a new home is brilliant because it keeps your overall monthly cost expenditures low. Okay. Now, what you do and how you do it from there forward is up to you. Okay. And so the biggest US problem is that people have more month left at the end of their paycheck, meaning that their paycheck runs out and there's still another week left in the month to buy groceries, fuel their car, send their kids to private lessons, sports, athletics, and all the other expenses that life bears upon you. How do you afford that stuff? So I've been telling people, I said, look, why don't you go out build? What if you never get rich? Okay. Wealth is off the table. Okay. But what if all you do is get rid of your mortgage payment completely? And instead of having a 50-year mortgage, what if in 3 years you can completely eliminate your mortgage completely? Just completely eliminate it in 3 years. And some people say back, well, how would I do that, Jerome? It's very easy. Just buy a piece of land, build a house. And if you do it in the upper middle class sector and you do it in excess of $700,000, ladies and gentlemen, guess what happens? You have about $200,000+ in equity in that house. If you live in that house for 2 years, you can sell it and capture 100% of the gains with zero tax liability. You can do 2 of these. And if you're a married couple, you can capture up to $500,000 in after 2 years and not pay any income taxes on that property or capital gains taxes on that property. Okay. Now, here's what I love even more is you could just turn it and you can just go in, you can just turn the house and create a tax liability for yourself. I'm okay with the tax liability. Here's why. Because I look at it like building any type of store, like a grocery store or anything. Okay. So you build a house, right? You build a house, 50-year mortgage. Get that thing 50 years, get that debt down as low as humanly possible. Take a 50-year mortgage on that thing and your overall out-of-pocket cost, bring it low, because when your overall out-of-pocket cost is low, your liability goes down because now your ability to service that debt is reduced. And so your overall out-of-pocket expenditures is low. Take that debt at 50 years. If they're going to give it to you at 50 years, here's one guarantee. You know where you're going to be for 50 years. It's not like these bullshit 5-1 arms. All of a sudden, you're hoping, you're banking that the market's going to continue thriving. That's what's happened to the commercial market sector today. Everybody thought that, and I mean, how fucking brain dead do you have to be and stupid to think that interest rates are going to stay sub 3%, dumbass? Listen, guys, and I say it like that because I was telling people since 2018 that interest rates couldn't stay this low and that asset values couldn't get this high, this fast, and that you were going to get crushed financially, and nobody paid attention. Syndicators kept buying stuff. And I said, build it, guys, build it. Bring in the equity. Bring in the equity. Stop buying these overpriced assets because they're not assets anymore. And people kept going in, buying them. And then even stupider, they were buying them on 3-1 arms and 5-1 arms, thinking that they were going to get out of these assets in 3 to 5 years, really believing that interest rates were going to stay sub 3% for 5 additional years. Ladies and gentlemen, historically, it's never happened, but yet you thought that it was going to happen. And now everybody's upset and mad because interest rates are back to a normal cost. It isn't that interest rates are even high right now. The problem is that interest rates went too low. And I kept sitting back saying, look, guys, it is economically impossible for interest rates to stay this low and prices to go up this quick. There is something that's going to blow up the market, and I don't know what it is, but it's going to blow up the market, and we're going to eat it, guys. We're going to eat it. And so I just kept building them. And I was like, you know what? I'm not buying this stuff. I'm not taking 5-1 arms. I'm going to leverage debt as long and as low as humanly possible. How, you guys want to know how our assets are stabilizing right now? You want to know why all my stuff is cash producing and why we have zero issues with financing banks and any asset right now? Is because I'm doing it through HUD. And what I'm doing through HUD is I'm taking these 35-year stabilized loans on commercial assets that are cash producing. So now I have a 35-year guarantee because I have a mortgage that I know this asset can perform on for 35 years, fixed rate, no volatility, and it just prints cash, prints cash, prints cash. Then when the interest rates do go down again, and I can secure that same debt for 35 more years at a lower interest rate, I just cash it out, pull in money, tax-free, and then it just continues printing cash again. And I just sit in it for 35 years. People are freaking out because a 50-year mortgage. Who cares? It's cheap money. Use their money and take your money that you're making, doing whatever you're doing, and utilize that to invest in something else. Okay? Not $300 a month in the stock market. That's stupid. Take the out-of-pocket expenditures that you have and now take that in and go spend that on compounding your money into an asset, ladies and gentlemen. Utilize that to go out and get a construction loan. Utilize that to go out and get a one-time closed loan. Utilize that to take advantage of having excess capital to go out and utilize for you. Ladies and gentlemen, I think the 50-year mortgage is brilliant. Keep your overall out-of-pocket expenditures down. Have a guaranteed out-of-pocket amount of money, out of pocket every month that's controllable, palatable, and now go in and start investing in assets. Ladies and gentlemen, everything that the 50-year mortgage is about for investors, if you're an investor, is positive. Take it and run with it and take it all the way to the bank and keep your overall out-of-pocket trash can money in your pockets and out of the trash can. Stop servicing the debt on these long terms. No one's going to live in a house for 50 years anyways, unless you're that 1/10 of 1% of 1/1,000,000th of 1%. And go out and buy land, build houses, take your equity in the front end, and go out and compound your success. For more content just like this, click and subscribe to our YouTube channel. Pound that thumbs up button. Give me some love. And until next time, God bless, and go out and compound your success. What's up, Champy? I was out of town when you guys showed up late, so I told my phone. This ground from shouldn't be before we go. No, it's not. I couldn't even say I couldn't come on. So can't be on time to me.
You know, I've opened so many times.
Oh, you opened so many times, man. Did you see that one at 505 Action Sport 505 game? That was so passive interference.
No, it's not passive interference. It's just like it's wrong. It's literally just underthrown. Like I had an E. I had to come back for it.
Your guy took his hand off the chest.
His hand with his hand. Yeah. So it's all like that.
What did the coaches say?
It's supposed to be out there.
They wanted me to go up and get it like that. This is about to overthrow. I mean, you can die for that other one. Look at how it goes. If you have gone there, go faster. I mean, it's really possible to land off you get screwed. You literally get served.
Yeah,
Is that what action sports do?
No.
Where did you get that from?
Yeah.
I got one more video to record.